The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you very much for being with me this evening. Good morning to our friends in Kiwi, including Mick D, who I'm thrilled is with us today and can hear us well, so that's great. And Hank down in the Hunter Valley, good afternoon to you, mate, and a Happy New Year, of course. So, great to have you all with us today, folks. And it's been a while since I spoke to you. And a whole lot has happened. I think one of the best decisions I've made for a long time was to decide to trade through the Christmas New Year period, where in previous years we've usually stopped trading a few days before Christmas and taken the Christmas New Year period as a holiday. And I've noticed that there's been so much action around some previous holidays that I decided this year to keep trading right through that period. And honestly, the trading has been fantastic, hasn't it? It's absolutely wonderful. So anyway, great to have you all with us. Let's see who's here. All my usual friends. Albert, of course, is with us. Ben, good to hear from you, Ben. Who else is here? Chase is with us. Thank you, Chase. Colin's with us. Dave's with us. David, OB over in New Zealand. David, how are you going? Good to hear from you. You ever going to allow me to get back into the country with your COVID, the shutdown? Right, it's all been pretty much two ways, particularly in Queensland, hasn't it? My daughter got, she's at med school in Sydney. She got stuck down there and we couldn't get her back during her holidays. So over the biggest break of the year for medical students, we got to see her for a whole 10 days. And we're lucky to do that. Doug, good to have you with us. George as well. Hank, my friend down the Hunter Valley. Jeff, good to have you with us. Jeff, he's a tutorial guy. Jeff's another Jeff S, is with us. And here we are. Joe's with us. Joel Goldman from Vero Beach. Good to have you with us, mate. Terrific. Keith's with us. He's a tutorial guy. Mark L's with us. He's a tutorial guy. Another one, Matt's with us. Mick D, of course, he's a famous trader. Murph, of course, wouldn't be a party without the Murph. Glad to have you with us, my friend. Miles, Peter Mack, who's not a day trader. Glad to have you with us, old fella. And Rob, of course, Rob H over in New Zealand, who is a very, very good trader and has always got an interesting stake on things. They're still coming in. Sean down in Adelaide, glad to have you with us, mate. Oh my goodness, we had a lot of people coming in late today, so take your time, folks. It's good to have you. Alan's with us. He's a tutorial guy. Grand. Okay, so let's move on. As we give people a few minutes to come and join us, we seem to have a whole lot of people coming in a few minutes after start time, which is fine. And we've got a whole lot of interesting stuff to talk about today because markets are really in decision-making mode in some pretty important levels, which is what I want to talk with you about. This is US T-bonds. This is the chart for 30-year T-bonds. This is the most important long-term financing tool that the US Treasury has available to it. And it's pretty interesting. You can see this chart, or the part of it you can see on here. And I've shown you this chart consistently since the website started in late 2008. And you can see that it has a Danielcode trading channel on it. They're the diagonal lines in red running across the chart. And you can see there's a thicker one in the middle. That's the median or the mean. and then there's one standard deviation above and two standard deviations above, and the same below the mean. Now, what's really interesting here is that I stopped extending the Danielcode trading channel back in 2016. So for the last 6 years, this chart has been on its own, and it's defined the highs and lows of the market, this market, absolutely perfectly. And what I want you to be aware of, if you're not already, and most of you are, is that real interest rates are the inverse of this chart. In other words, if this chart is going up, it's telling you that interest rates are going down. And if this chart is going down, it's telling you that interest rates are going up. Excuse me. And real interest rate on this particular security, which is an unconditionally guaranteed by the US Treasury and the US government, real interest rate for this security is simply the difference between the current price and the face value of the security. This is a product that redeems at full face value on maturity. But this is such an important market that you really got to think seriously about why is the Fed telling us one thing and the market's telling us something else. Now, I understand that to the vast majority of institutions who are essentially the Fed's clients, the shorter term treasuries, bonds are more important. But this is the basis, the most basic of all official Federal Reserve price targets, because this affects all of the other rates as we go along. And what you can see here is that this market has been going down since its high a considerable time ago. And in fact, you can see that high was on March, this is a 24-day chart you're looking at now. So that high was made in the month ending March the 30th, 2020, and it's been down ever since. In other words, it missed the 89 cycle by one period at that high, which is pretty deadly accurate for a chart that started way back in 2000. And since then, it's been down. And that means interest rates are going up. And what we've seen lately for the last 9 months, effectively, is a battle of support at the dotted red line, which is one standard deviation below the mean. Now, that's not your normal mathematical standard deviation. That's a Danielcode standard deviation, because we use ratios for the standard deviation that reflect the Danielcode levels. That's why they're so amazingly accurate. And if you look at that in a bit more detail, you can see that this market has been really fighting to hold that dotted red line on the close. Excuse me. Bit of hay fever. On the close, and this current bar hasn't closed yet, but this is going to be the first bar for quite a while that's closed clearly below that support. And that's telling you that as this chart goes down, interest rates on this security, the UST bond, are going up. And that's something to think about, isn't it? Because that's quite different to the rhetoric we've had lately. This is what it's like on the daily chart. It's had a nice run down, and remember, as I've said, down is up on this chart. Interest, this is the price of to trade the T-bond. As this goes down, it means interest rates are going up. As you can see, there's been quite an interesting push down, including that big bar day right here, where Goldman Sachs came out with a note saying that was the biggest risk unload by their prime clients for a number of years. So that's momentum, creating the big bars like that, bit of violence in the market really creates momentum. That's not the only thing that's happening here, because the Fed has, and US Treasury have many, many more tools than simply the face value of T-bonds. It's what really moves interest rates more than anything is the various tools that the US Fed has, including repos, where they're buying these bonds back from dealers. And that's a very, very opaque business, I can assure you. I've spent some years ago a whole lot of time trying to understand exactly what the Fed was holding out to its major institutional banks on the repo business. And as I say, about the best you can say about it is it's very opaque, but it's a very powerful weapon because that's the money talking. And today, here we are, we had an outside bar, as you can see. So we had a nice sell that ran all the way down to the blue line at 154.24, and the low of that bar was 154.20. In other words, only 4 tick variance at the low. It looks like it's more on this chart, but this chart's pretty expanded. So we had a nice TO3 sell signal running into that, and at that low we had a TO3 and a blue line buy signal. Then we had 3 hard days up, the third one of which led to a TO3 plus sell for today. And what happened is today we got an outside bar. Now, outside bars are very emotional issues for a whole lot of traders, but they needn't be. They're a reality of trading and something you just have to get your head around because they happen and then they happen again and they keep happening. They're part of trading. And what's happening with an outside bar, basically, this is a pretty straightforward example, is that the market gets to a level where there's either a time or a price sell signal. In this case, the market was going up, and we gave you a TO3 plus sell signal for today, which was elected by the narrowest of margins. I use a 2-tick buffer below the true highs and true lows for our setup of our Danielcode trade signals, and this little rotter here managed to go down at 3 ticks, just enough to fill us, and it then reversed and went up and made an outside bar. Now, what happens with outside bars is that the signal creation process assumes that the market is in equilibrium, that there's a balance of bullish and bearish players in the market. And the market reaches a stage where it's due for a turn. Might be a very minor turn, might be a major turn. The Danielcode is mute on quantum. But what happened in this case, and this is what happens with all outside bars, is the trade was elected to the downside. And at that stage, additional momentum came back into the market on the upside. The additional momentum always comes to support the existing trend. And the existing trend here from our TO3 and blue line buy signals has been up. And the market then goes to this, what we call the flip point. In previous webinars, I've called it as well the failure point. And I think we're going to start calling it the flip point, because that's the point where the market's telling you that you're wrong and you should stop and reverse. Now, for those of you who don't look at markets during the day, you might find it very hard to stop and reverse on outside bars. But most platforms will allow you to do it. So have a talk to your platform provider about how you put together your signals to take advantage of outside bars, because by and large outside bars tend to be trend continuation signals. That's not always. You can get, particularly in equities, you can get a very big outside bar that's actually an exhaustion move, but the vast probabilities are with the outside bar being a trend continuation move. So at the point that you reach the failure point, which we now call the flip point, that's telling you you're wrong and you need to do a stop and reverse and get back with the old trend that is continuing. That's basically what outside bars teach you. And that can happen, when you get the reversal in the day of a new entry, that's an outside bar. But you can get the same pattern extended over time. In other words, you can get to the flip point on the second or third day. So the Danielcode signals are so powerful that a failure in the signal is telling you something. And what it's telling you is the original trend is reasserting itself. So think about that. If you're not clear on it, always feel free to drop me a line and I'll be happy to talk about it more. Okay, so that's what happened today. So that's what you got to think about with these supposed interest rates rising. It's not yet reflected in the chart of the 30-year bond now. A whole lot of this stuff works on shorter time frames, I know, but that is a primary tool of the Fed. It's interesting that the trend in it so far has been down, and it's now breaking a little bit further down. So once it reaches the bottom dotted red line on that chart, that's really going to be a momentous occasion for bonds. So be aware of that. Gold, this is the fourth seal on gold. This is Frank DB's commentary on gold. He thinks that gold is basically in a bear market. He's saying this is a big setup for gold. If the current bar bites and goes below the previous bar, it could set gold up for a big decline. And he tells you what the cycles are there, which is kind of interesting because there's some technical issues that actually say the opposite. Gold has been pretty stunted, pretty muted in its trading lately, and I found that silver's offering better trading opportunities right now. But essentially, gold has been in a large trading range for a very long time. Here's the long-term chart. This is a 24-day chart, and there are two charts here. The chart on top is gold, and the chart at the bottom is the US dollar index. And you've heard me talk over the years incessantly about the inverse correlation between gold and the US dollar. Effectively, what that means is if the dollar goes up, gold tends to go down. If the dollar's going down, gold tends to go up. And that's been a very, very valuable correlation for traders to be aware of. And it's one of the things that makes gold and its highly correlated partner silver such great trading for us. But on the 24-day chart, you can see that this correlation, this inverse correlation, has been broken for a considerable period of time. Whereas if gold's going up, the dollar's going with it, or if the dollar's going up, gold's going with it, if you prefer. That has been a change we've seen before. And the interesting thing that I want to tell you is that some years ago, maybe quite a few years ago, I did an article on this inverse correlation and did a whole lot of research on it. And historically, when the inverse correlation is broken, this is an occasional thing. It's in some respects you could say it's the normal position for gold to be in an inverse correlation with the US dollar, but it comes and goes when you look at the shorter term charts. And historically, when the inverse correlation has broken down, it's always been very bullish for gold. So looking at this longer term chart, I'm talking to you, I'm saying expect gold to break out to the upside. Expect gold to gather itself together and get out of the stupor it's been in for some months now, and get active on the upside. However, have a look at this. This is the just a close-up of what I was showing you. And you can see quite clearly on this long-term chart, the inverse correlation hasn't been working for quite a while on the long-term chart. That is when gold's gone up, the dollar's gone up, or inversely, if you prefer, if the dollar's gone up, gold has gone up. And if the dollar's gone down, gold has gone down, but not as far. So what does that mean? Well, have a look at the daily chart. This is the same chart, but this is the daily view of it. Gold on top, US dollar at the bottom. Now you can see that this market now, since about, late December, I guess, has been really fighting to re-establish that inverse correlation. So I don't know whether that negates the historical push upwards, but what we can say about gold is there's been no real pressure, no real selling pressure in gold, really, since late last year was the last little bit of a sell-off we had, which was pretty much immaterial. It's simply got down to the previous lows on the daily chart, and it's been up to sideways since then. But bear in mind that capacity. If this inverse correlation fails again, then you should expect gold to be very bullish. Okay, so here's the US dollar for you. It's had a long period of sideways action. It's been pretty well sideways since mid-December until 3 or 4 days ago, and it's finally given us a real breakout bar. Breakout bars are not what you think they are. For those that you've done a tutorial, you know what they are. Basically, we require a close outside the old range, and we got that on yesterday. So that's interesting, and of course it's right down, tagging its blue lines at 94,965 to 94,985, right in that range. Stochastics oversold. That's setting it up, I think, from there to rally, but it's still on a sell signal. Keep an eye on that. It's very important. So the weakness in the US dollar has been absolutely great for our futures trading. It's boosting the risk currencies, so the Aussie dollar and the Canadian dollar. The Aussie and the loonie, as they're referred to, both benefited greatly from that. This is the Aussie dollar breaking out to a new high on its recent range, and you can see that here is the Canadian dollar. Now this is the inverse. This is the US dollar Canadian dollar. So this chart going down on its recent TO3 plus sell signal, it means that's the US dollar going down, and the corollary of that is that the Canadian dollar has been strengthening against the US dollar very considerably. This has been a couple of very good down moves here, but it's finding support right about where it is. In fact, it should be, I'm sure I'm right, this market, US dollar CAD, is on a blue line buy signal at the moment, and it's put in a little key reversal bar today. So expect this particular down move to end pretty shortly. Okay, very interesting what's been happening Forex. Have a look at this chart and see how incredibly accurate these markets are. These blue lines have been on your chart for days, weeks, some of them for months. And look what this market's done just in the last 2 days. This is the euro, and we've had dollar euro here. So we had this big breakout bar on Wednesday, but look where this market stops. It's quite extraordinary. The high of that big breakout bar was 14529 against the blue line at 14528, one tick variance. Then we had this little weaker bar, still an up bar, but not much strength to it today, and the high of this 1.14816. There's the blue line, 1.14826, 10 ticks variance, nothing in the scheme of things, is it? So very, very interesting, and we'll see if it can. It's facing a sell signal now, I suspect. Euro USD maybe. That was yesterday, we'll see. Yeah, it's on a TO3 sell signal Wednesday and Thursday, and it hasn't been elected. So yes, it is. We've got a now today. We've got a TO3 sell signal and a blue line sell signal on this particular market. So be interesting to see if it can hold above the old consolidation range, which would be a sign of continuing strength. And of course, what's really happening, this continuing strength, is dollar weakness. And the US dollar is just weak, I guess. It's as simple as saying that. You haven't got to say a whole lot more. But that's making a lot of these currencies very much stronger. This is the British pound, GBP USD pair, and you can see it's had a terrific run up from its recent TO3 buy signal, which was GBP USD. There you are, you're looking at it now, and that buy signal came December the 20th. This was this whole period that normally we'd be shut down, and it's been wonderful. But look what's happened in the middle of this. We've had two sell signals, and they've both been blue line sell signals. Now, the Danielcode blue line signals are the most powerful signals that we have, and they have a number of pretty strict conditions on them before they'll issue. And this market's had two of them, and all they've done is cause a one-day counter trend, and it's gone back into its major trend. So let's see about that. You can see how accurately it's been tracking the numbers. But really what's happening here is, I've talked to you in the last 6 months, maybe longer, about these failure points, which we now call FlipMe. And we might be able to find a way to get the computer to remember these so we can create these as new signals for you, because in a trending market, market law is that markets will only correct for 1, 2, or 3 days. Now, that's not strictly speaking correct. Inside bars make that a bit more complex, and often enough they'll correct for 4 days, not counting inside bars. But these failure points, if they come fairly quickly, that is within 3 days of the original Danielcode signal, which these did, these FlipMe marks I've got put on the chart for you, both came within the first one at the bottom, elected the old failure point, which is now the flip point, 2 days after the signal, and the higher one there 3 days after the signal. So if a Danielcode trade is elected and the failure point, which is essentially 2 ticks above the high or the low of the setup bar, if that is elected, that becomes a FlipMe trade. What it's saying to you is that the original momentum, or the momentum in the original trend, has been re-established in exactly the same way as I've talked to you about the trend, the original trend being re-established with outside bars. This is, if you like, a pattern that's essentially a delayed outside bar. And it's very, very potent. In fact, if you did nothing else but look for FlipMe trades in trending markets, you'd be very highly rewarded. It's very, very good, and I've traded them for a long time. So be aware of these, what the old failure points. We're now going to call them FlipMe points. They're the place where the market is telling you you're wrong. And this is very, very accurate stuff. This is happening on a 1, 2, or 3 day basis. You're not sitting out there waiting and wondering like you do if you happen to be a poor, benighted options trader. If you're trading futures with the Danielcode, you know exactly when your trade is wrong. And that allows your risk management, of course, to be so much better. Okay, so there we are with that. This is the dollar yen. This is the same thing as we've just been talking about. Dollar weakness here, and yen strength, which had a nice big push up into the beginning of the year, and well, not to 5, 6, 7, 1, 2, 9 days ago, and you can see there's that big bar, and it stopped right at the blue line. So you've had a big expansion of the range there, USD JPY, and that big bar, which was on January the 4th, excuse me, that's the biggest bar in that whole range, and the high of that bar is 116.344. Have a look at the blue line, 116.357. 13 ticks difference. Nothing. It's not even a hair, is it, in this market? And of course that set up a very nice TO3 plus sell signal, and we've ridden this run down since then. If you look at the run up, which started with another TO3 plus buy signal back on December 17, in the middle of that you can see two grey bars. The grey bars are outside bars. So there were TO3 plus sell signals on both of those. On the second one, the higher one, it was not elected because for our daily trading in the TO3s and TO3 pluses, if we get a signal on an inside bar, we actually execute it on the last bar that was not itself an inside bar. So the first of those ones, the TO3 plus signal, was executed and turned into an outside bar. In other words, you were wrong and you had to be long at the close of that bar as soon as it took out the old high. And you've been well rewarded. The market's really rallied up since then, but it's given you this wonderful example of sometimes a big momentum bar can be an exhaustion bar, and that's essentially what happened here. That's an old-time expression. It's not really relevant to anything now other than a point of interest, because the Danielcode signals rule anyway, regardless of the size of the bars. You can see today, look at this market here, this thing of great beauty. If you're a lover of charts and markets, as I am, close of this bar 114.183, and there's the blue line, the red line I should say, 114.086. Absolutely marvelous. And the low, just a handful of ticks away from the next red line, which is the minor retracement on the downside. The number sequences of the ones closest to the market are the minor cycle. The other ones outside that are the major cycles. So this thing has been a very nice trade for us. Okay, let's see what else we've got to talk about. So this has been interesting. Copper. It's just been as dull as dishwater. It's just been sideways, a bit down, a weak rally, a bit more down. No momentum at all, and certainly apart from the last 2 days, if you take the 8 or 9 days before that, it has really been trying to find out what it's doing. It's been up and down on the daily bars, and eventually, quite recently, it has, here we are on, it was Thursday. Last week, it found its support at that 431.55 DC retracement, and whoosho, look at it, huge bar yesterday, and a complete breakout from the old trading range. So just excited to see what copper does now. And interestingly, it's called Dr. Copper by traders because it's taken that when the copper market is strong, it's generally a sign that the economy is good. And of course, we've heard the Fed, US Fed, now talking about the state of the US economy, and it's it's in great shape and it's roaring, as you would expect, with the massive numbers in the equity indices so far. Okay. We've done that. We've looked at that. We've gone to copper. Here's the next one, crude oil. We're getting a pretty steep rally in crude oil, as all you most of us know. I mean, in Australia, we have massive taxes on petrol, and boy, the price of petrol. You think it's high in the United States. Be grateful. There's not a whole lot of taxes on petrol in the United States compared to the level of taxation in Australia and New Zealand, where it's very expensive to buy petrol. I'll leave it that way. You can see there that crude oil vacillates between having an inverse correlation and a direct correlation with the US dollar index. And you can see how it's changed with that over time. These are a daily chart, but it goes back to February last year. And you can see we had a big inverse correlation March, April, May, June last year. And then we've had the rally, and that ended in about early September last year. And since then, this market has been pretty much working in conjunction with the US dollar index until the last few days, where it's now beginning to show that inverse correlation again pretty strongly. Don't read too much into that. It's interesting, but there's not enough of a historical pattern in there to say what the probabilities are, other than this market is up very strongly, and petrol is priced accordingly. Okay, so this is the same thing on a 24-day chart, and you can see much clearer the inverse correlations on the 24-day chart. It's not so effective recently, certainly on the daily, but these correlations or inverse correlations here are quite loose. They're nothing like as accurate as the usual inverse correlation between gold and the US dollar index. But nonetheless, it's interesting. Okay, so this is what we've got for crude oil at the moment. It's roaring along. It's had a little inside bar today, which was caused by the market hitting the Danielcode blue line, which is at 83.04, and the high of Wednesday's bar was 83.10. So 6 ticks variance is all, folks. Pretty nice, isn't it? And 82.94 the high today. Yeah, so that's the strength of crude oil and the pain it's delivering at the pump. And I know in the States and Canada, you're feeling the pain as well over there, folks. Righto, so let's have a look about this wonderful movements that are going on in equities. This is the fourth seal from Frank DB and his comment from last week and the present week. And what he thinks is that we've entered the 24-day cycle. It's on a 59 expiry that can cap this bull market rally. Frank's been looking for that since May, June, July last year, as you know. And what he's looking for is the market to make a new rally now, and that's to be the last rally of this bull market. There's an 89 cycle low running until today, January 14th, today at least in Australia, tomorrow for you in the States and Canada, and follow the signals as they will guide us. Very important. Danielcode price and time signals have precedence over everything else. So it's interesting where they are now. We've got a nice little bit of divergence. This is the S&P. It ran up and gave us a TO3 plus sell signal, which was caused by there was a red line there. Might have even been a minor blue line as well. So we've had a nice rally, made plenty of good money. That rally started December the 20th, and it ran up. It actually made a key reversal bar against the blue line on December the 30th. So that was a nice little run up over Christmas. It was certainly worth trading it. And then we've had a key reversal bar on January the 4th, which is triggered a TO3 plus sell signal, which has run down from there into the TO3 buy signal. What's really interesting, you'll see in the next chart, I think, is the NASDAQ got that buy signal the day earlier, a day before. Pretty interesting stuff. But you can see that this market's just been running off Danielcode support and resistance, and responding to the DC buy and sell signals, TO3 and TO3 plus signals, absolutely fantastically. And I've had occasion several times this year to write in praise of the TO3 and plus signals, because they are extraordinary, and they've done so well for us now in our 13th year. We've been doing this a long time, as you know. Really nice sell signal today. But there's no violence in any of this. This market's just taken out some highs, going down to a low, rallying a bit, blah, blah. There's no violence at all in this market. Big bars, these are nice big bars, but no violence. And violence is what we'll get when this market finally decides to turn up its toes. Okay, so what have we got here? NASDAQ. This is interesting because it's been working just as well. It had the TO3 buy signal 4 days ago, and it came a day before that big key reversal bar, which left it with a massive, great big tail on it. And that was pretty obviously a buy signal for anyone, particularly if you knew that it had bottomed very, very close to the blue line, within a handful of ticks of the blue line at 15,164 1/4. And the previous day, the close of the previous day, a few ticks away from 15,563. Danielcode target recognition is valid on the bar, high, low, or on the close. This was a case of target recognition on the close, which created the TO3 buy signal a full day before we had that big snapback reversal bar, which is really interesting, particularly if you're a shorter term trader. It gave you a clue that that move down might not go as far as you thought. But that's what we got. 2 days up, straight into a TO3 sell signal for the day. Down it's gone. Look at its target recognition. It's closed at the 59 red line, almost to the tick. Very, very good target recognition. And the NASDAQ has not always been the best market to recognize DC trade signals, but in the last couple of years it's been as good as any of them. It's pretty fantastic. And Ray Brasker, no sound, you say? Not our problem, old fellow. The sound here is okay, but I'll be posting a recording of this, Ray, I know you can't hear me at the moment. Perhaps it's come back to you, and you'll be able to catch out on whatever you lost there. I take it the rest of you, the sound's all right? All the lights are on here. Yeah. Oh, the Ray says the sound is back. Good. Grand. Okay. If you've missed anything in there, Ray, have a look at the video, which we'll post probably tomorrow, and you'll be able to pick up on anything that you missed. Okay. So that's pretty much us for the time being, folks. Everything you've seen me do in these tutorials over long periods of time is taught to you with the Danielcode tutorial. Those of you who want to be very, very good traders, and the best way to do that is to take the Danielcode tutorial. And if you're interested in that, send me an email, jneedham@thedanielcode.com, jneedham@thedanielcode.com, and I'll be happy to send you material. And if you wish, talk to you about undertaking the Danielcode tutorial, which will turn you into a super trader if you do it right, which of course you do. We've got interest of lots of things we talk about in trading, but the real business of trading futures and forex is not to be right. The business of trading is making money, and that's what we're all about. So let's see what we've got. Here we are. I'll come back to you guys who've asked questions here in a moment. If you haven't already, folks, you're most welcome to take a free trial. Go to www.thedanielcode.com to start your free trial. Just hit the register button. Any issues you have, if you've had a previous free trial in particular, the computer may remember you and not allow you to create a new password. Any issues you have with your free trial, contact Terry at support@thedanielcode.com, support@thedanielcode.com, and he'll be happy to get you going. Remember, there is a large amount of risk in trading futures and forex. There are massive levels of risk if you don't know what you're doing, and most traders don't. Interesting, during the week, very interesting article in the Sydney Morning Herald, one of our major newspapers in Australia. They're profiling a Australian youngish man. Compared to me, they're almost all youngish these days, aren't they? Who had set up a Forex and CFD brokerage in Europe, but he was an Australian guy living in Monaco now. Got so much money, he doesn't want to pay tax, which is always a sensible thing if you can do it. But he had something like a 900 million dividend out of this comparatively new business, and pays a very, very substantial Australian tax. So it was really a puff piece on an Australian expat doing well. But what was interesting was the massive amounts of money he's accumulated. He also trades forex, and it may well be I think it's called CI, the platform. So they may be one of those unregulated forex platforms that takes the other side of the trade. And they all used to do that until the US regulators got concerned and cleaned out a lot of the US forex platforms. Anyway, it really was more proof that how much money people lose. Quite extraordinary. ETFs, or CFDs, I think I meant, contracts for difference. I think they're banned in Australia. They certainly tried to ban them. ASIC tried to ban them. I don't trade them, and I have no interest in them, so I didn't follow that. Okay, so that's us for the moment. Let's have a look here from Stephen. For NASDAQ, do you buy TO3 buy signal day or the next day? Market broke 60 points the next day, and that was the bottom. Your TO3 buy signal, let me show you, Stephen, is the simplest way of doing it. If you go to the Danielcode website, You will see that the signals are posted here. They'll either be TO3 signals. You can see them today. Here you are, or they'll be TO3 plus signals. And they'll display in a moment. There they are. Once you've done that and got your signal, go to this link here. It's called the Danielcode Trade Program. And what it does, it lets you put in whatever the account size you're trading. It lets you nominate whatever percentage of risk you want. And then if you calculate contracts that define risk, it'll whiz around, spin around, and it'll come up with this document here. And this tells you what the market is, what the current signal is, the entry point, your stop loss, a first very small target that was originally designed, and it was designed a long time ago for newbie traders. So you can get to that first target pretty quickly, which should be, if you're trading that way, a trigger to move your stop to break even. That's just one way of trading these signals, and there's notes about it down the bottom you can see. But it tells you whether this is a correlated trade or not. You can put in the number of contracts you want to take. It'll calculate all that for you. Let's say you want to take 3 of these. Let's see if we don't have a current NASDAQ signal, otherwise it would be displayed here. Let's say we want a couple of these. Whatever you want, just put that in. Ask it to calculate. It'll all spin around and it'll come back and tell you what your total risk on entry is if you are using those entry points and the suggested stop loss protocols. Okay, so yep, I think that's it, Stephen. So it will carry forward if the signal is still valid for you. But basically, TO3 signals are valid for the day of posting and the next day. TO3 plus signals, we expect them to be elected. That means the market's gone to that entry point that we specified in our trade program on the day of posting. But it's worth writing those down and following them, because often enough the signals come a bit early and the TO3 plus signals will still be effective the next day. Our blue line signals, which are the most important and strongest of all of our signals, they're valid for the day of posting and the next 2 days. So they're valid for 3 days. And that's because the time cycles, those of you who've been interested in time cycles, can come, the Danielcode time cycles can come 1 or 2 days early quite easily. We want them to come early. We don't want them to come late because then they're of no use at all. The market's gone. So that's where we are. So Akshay, good to see you. Joined us here, mate. Alan, of course. And thank you, folks, for being with me. Boy, a few have come in. Rolf down in Melbourne. Must write back to you, Rolf. I understand what's happening there to you. Ray's with us, Mark's with us, Lev's with us. Lots of people I haven't already said hello to. Chip's with us. Great to have you with us, Chip. Been a long time between drinks, hasn't it, mate? There we are. Have a great weekend, folks. That's us for the moment. Do write to me. Do email me if there's anything in particular you'd like me to analyze or talk about. I'll look forward to talking to you soon. All the best. Bye-bye for now.